Building a Pokemon investment portfolio might sound like something only kids with too much allowance money would consider, but here's the reality. A lot of collectors have turned their childhood hobby into some serious wealth. When I first started thinking about how to build a Pokemon card investment portfolio, I quickly realized that there were a lot of strategies I wish I had known from the start. From understanding allocation percentages to timing the market cycles, I learned through expensive trial and error. In this video, I'm sharing the exact framework for building a balanced Pokemon investment portfolio that can actually complement your traditional investments, so you can avoid the costly mistakes that I've made. That this video shouldn't be construed as financial advice and it should be used as entertainment purposes only. Do make sure to do your own research before buying into Pokemon cards. The foundation. Now, before we talk about percentages and strategies, let's address the elephant in the room. Yes, I'm really serious in suggesting that you might want to consider Pokemon cards as an investment vehicle. And no, I haven't lost my mind. But here's the thing. Most people don't realize that Pokemon cards have consistently outperformed many traditional assets over the past decade. While your index funds were delivering a steady 3 to 7% annual returns, certain Pokemon products were quietly delivering like 20 to 700% annual growth. Some sealed booster boxes have seen 10x returns in just 5 years. But here's where most people go wrong. They try to treat Pokemon cards like a get-rich-quick scheme instead of what they actually are. It's an alternative asset class that requires strategy, research, and patience. But first and foremost, it's most certainly just a hobby that we all love. But just like you wouldn't put your entire 401k into a single tech stock, you shouldn't bet your financial future on a Charizard card no matter how shiny it is. The key is treating Pokemon investments as part of a diversified portfolio, not as a replacement for traditional investing. Think of it as adding a high-growth alternative asset to your mix, one that happens to be a lot more fun to research than quarterly earnings reports. The 80-20 rule, your portfolio foundation. Let's get practical with some real numbers. If you're serious about building wealth while having some fun with Pokemon, here's the allocation that I would kindly suggest. 80% traditional assets. This is your boring but brilliant foundation. We're talking stocks, ETFs, real estate, bonds, whatever fits your risk tolerance and timeline. This is the money that's going to fund your retirement, not your nostalgia. Now 20% can be to volatile investments like Pokemon. This is your alternative asset slice. Higher potential returns, but also way more volatility and definitely more hands-on work. You'll need to stay current on set releases, understand print runs, and actually know the difference between a Charizard and a Charmander. Now, I know what you're thinking, only 20%, but I've seen people make a ton of money on Pokemon cards. And you're right, some people have. But for every success story that you hear about, there are dozens of collectors who went all in and got completely burned when the market corrected or when they picked the wrong cards. The 80-20 split keeps you grounded while still giving you meaningful exposure to Pokemon's growth potential. Plus, if your Pokemon investments completely tank, you're not eating ramen for the next decade. Inside your Pokemon allocation, the strategic breakdown. Now that we've established that about 20% should go into Pokemon allocations, let's talk about how to structure that slice for maximum potential. This is where most people just start buying whatever looks cool and where smart investors separate themselves from the pack. It's just a suggestion, but here's a balanced approach that might work well for you. 40% sealed product. This is your stability play. Think booster boxes, elite trainer boxes, and other sealed products from popular sets. These have the most predictable growth patterns because scarcity is guaranteed. Nobody's printing more base set booster boxes. 35% individual cards from recent sets. Focus on popular Pokemon like Charizard, Pikachu, Gengar, and Umbreon, etc. from current sets or recently released sets. These give you exposure to the cards that drive the most collector interest. 15% vintage cards. Anything 10 years or older with established demand. These are like your blue chip Pokemon investments, slower growth but proven staying power. 10% speculative play. This is your lottery ticket money. We're talking undervalued sets, emerging trends, or cards you think the market is sleeping on. Most of these won't pan out, but the ones that do can be massive winners. This breakdown gives you exposure to different risk levels and time horizons within your Pokemon allocation. You're not putting all your eggs in one Pokeball, so to speak. The time era strategy, vintage, modern, and the magic zone. Here's where things get really interesting and where some investors might miss big opportunities. Not all Pokemon products are created equal, and timing the market cycles can make the difference between modest gains and life-changing returns. Let me break down the three eras and why the middle one is where the real money's made. Vintage, which is 10 plus years old, 20% allocation. These are your established classics. Base Set, Jungle, Fossil, Neo Genesis, the cards that started it all. While these can still appreciate, much of their major growth has already happened. They're like blue chip stocks, steady, reliable, but not explosive. Modern or current releases, about 50% allocation. This is where you catch products at retail price and ride them up as they go out of print. The key is identifying which current sets will be tomorrow's classics. Not every modern set becomes valuable, so you need to be selective. Vintage Modern, 5 to 10 years old, 30% allocation. Now this is where the magic zone happens and where the biggest gains happen. These are products that have been out of print long enough for collectors to realize that they're not coming back, but not so long that they're considered vintage yet. And here's why Vintage Modern is so powerful. When a set first goes out of print, casual collectors don't panic. But around the 5-year mark, people start realizing that the booster box that they could have bought for $120 is now over $400. That's when you see the first major price surge. Then, if the set eventually transitions from modern to vintage status around the 10-year mark, you often see another 10x or plus more in gains as it becomes a true collectible status. The long game, why patience pays. Now here's the final piece of the puzzle. Pokemon investing is a long-term game, and the biggest returns come to those who can hold through market cycles, resist the urge to panic sell during downturns, and stay disciplined about their allocation strategy. Remember that you're not just investing into cardboard, you're investing in one of the most successful entertainment franchises in history, with a global fan base that spans generations. As long as people have nostalgia and disposable income, there will be a demand for Pokemon cards. But like any investment, success comes down to strategy, research, and discipline. Treat it seriously, manage your risk, and remember that even the best Pokemon investment portfolio is still just one piece of your overall financial picture. The goal isn't to get rich quick, it's to build wealth steadily while having a lot more fun than you'd research municipal bonds. And honestly, isn't that a pretty good deal?